I'd like to also introduce Daniel Stewart Roberts. Daniel is the chairman of WBC. He's a UK-based chartered accountant and was previously a partner at Deloitte Oil and Gas Division, and then went on to take on various finance roles in small cap E&P companies. Daniel has experience in the UK, continental Europe, and Russia. So I'm delighted to welcome him to the call, and he'll be helping to present today. Okay, in terms of timing, the presentation will take about 40 minutes. We'll then have Q&A, so we should be wrapped up within an hour or so. I will be recording. I am recording today's session, so if you miss a bit of it, or for those that can't make it, that want to catch up later, I'll be sending out the recording in an email later today, along with the slides. Okay, so let's get to the agenda, and let me show you how we're going to structure today's discussion. And we've broken up the main elements of an E&P business case into 14. Now, this is one way of doing it, of course, and this is a broad topic that needs to cover many different elements. And of course, given the time available, it's going to be difficult to get into every last detail, but I hope we will leave you today with a good checklist that you can apply in your own situations. But of course, the caveat is that there will definitely be things that you will need to look at for your projects and ideas that perhaps we don't touch on today. So that's the caveat. So we've got 14 key elements that we're going to run through at a little bit of speed, obviously with the time available. And we've grouped those into 3 main categories. So we have the what and the where, the why, and the how and the when. So the what and the where is the resource, local country assessment, the market assessment, and local laws and regulations. The how and the when is the granting instrument, the development and production concepts, finance, infrastructure and export systems, supply chain and logistics, and HSSE. And then the why is the strategic fit, economics, competition, and downstream opportunities. So we're going to get straight into this. We'll start with the what and the where. We'll then move over to the why, and then the how and the when. Okay, so let's move straight into it and start with the what and the where of your project or idea. And we're starting with resource. The natural resources that are available. And of course you will, or your geologist will be building geological models of the play and the basin and the prospectivity that's present there. And these geological models will need data to drive them. And of course, the amount of data that you have will play into one of the key risks that you're taking on with your venture. So within this, of course, the size of the resource that you're looking at and the potential for material business and growth for your company is paramount. So, and of course, depending on your company, that will determine what you mean by material. But the size of the resource and the impact on your company and your company's portfolio will need to be detailed. And of course, then we'll need to talk a little bit about the type and quality of hydrocarbon. Is it oil? Is it gas? Is it condensate? And the type and quality of hydrocarbon will influence, of course, how we develop the field, how we transport hydrocarbons to the marketplace, how they're processed, and the eventual price that we get for our oil or our gas. So these are obviously crucial elements of a business case. We will need to discuss the risks and uncertainties. And the 3 big risks and uncertainties, of course, around resource are the volume, the rate, and the quality. So these will need to be detailed and discussed and characterized. And then, of course, I think it's, now I know some folks will be very familiar with this, but others perhaps less so. And that's the issue of reserves versus contingent resources versus prospective resources. So what are we talking about in your particular business case? Are we talking about reserves, which have a high, by definition, have a high chance of being extracted? Or are we talking about contingent resources where there might still be some development risk? Or indeed prospective resources where there will be exploration and development risk? Okay, so the next section that we have is around the local, country and regional assessment. And so this is to do with the politics of the region or country where you're working, any government and institutional dynamics that play out. So what role do each of these organizations play? How do they work together? And how does this change over time? So you might take one view of the political situation and how these various institutions work together, but it's likely to be dynamic. And so you'll need to take a view of how that may change going forward. Another area where we'll want to take a look is economic policy and the local conditions. So for example, inflation, currency, any local factors that might impact the economics for our project. Other examples might be any pricing arrangements, domestic oil pricing arrangements as an example. And then we'll need to assess the and show in our business case the local any local and regional capacity considerations. And so this really covers the area of service companies and the maturity of the service company industry in the region in which you're working, any skills or equipment gaps that might need to be filled. And then in the area of capability building, what capability building the oil and gas company, your company, may need to carry out, and obviously and clearly the role of government in any capability building initiatives. And then lastly, I just wanted to mention PESTLE. I know some of you have come across this before, but this is a nice way of arranging our thinking or our analysis, or and making sure that we cover all the bases, so to speak. So PESTLE: politics, economics, social, technical, legal, and environment. Well used. It is a good way of organizing our thinking, and I would suggest that 80% of the issues that you're likely to encounter, at least in a business case, will fall into one of these. There will be others, of course, but a good way to make sure that you've covered the necessary areas. Okay, so moving on, still in the what and the where. We have a market assessment. So I'm talking here now, when I say markets, about the markets for the oil and the gas or the hydrocarbons that you're going to sell. And you know, it still still amazes me how often E&P companies get this wrong. It does still happen, and I think the reason for that is we tend, as an industry, to take a resource view of projects. So we're focused on the resource potential and the risks and opportunities around that, rather than thinking about how we're actually going to market and sell our production. And many examples of companies that have come unstuck with this over the years. I'm sure you can think of a few right now. So a very important aspect. After all, it's only when we sell the stuff that we're generating revenues and we actually have a business. So in this section, I would expect us to look at, in the business case, at the markets that are served, how big they are, where they're located, and growth prospects, and also any competitor activity. And we see this play out particularly in the gas business, because oftentimes the gas will be sent, for example, in a major pipeline, or in an LNG project as another example. The gas will be sent to a very specific market by definition. And so these considerations are paramount. But it is also true on the oil side of the business. Most oil goes to the international markets, that's true, but not always, and particularly landlocked regions or landlocked countries that have difficulty getting their oil into the international markets, there may well be or will be local considerations. And then we're into the transportation and storage and blending issues for your oil or your gas, and any impacts that these might have on the marketability of your hydrocarbons. And the one that springs to mind here is any quality impacts that may be present. So, for example, on the oil side, any contaminants or the quality of the oil that you have that may impact the price that you get in the marketplace. Okay, so that's a look at the market assessment. Let's move on now to local laws and regulations. And what we're talking about here really is the industry structure for the country in which you're investing. And we think about, of course, the various players that are there, perhaps a ministry, a national oil company, a regulator, and how they interact and what they're responsible for. So what does each of these players do, and how will you relate to them, and what plans do you need to put in place to make sure that these relationships work well? This may or may not make it onto your business case. It's not always an issue, but in some regions and some countries it definitely will be, and you'll need to mention it. And that kind of flows through. An example of this is the issue of standards and what engineering standards that you're working to. And there might be a decision to be made between your company standards and the local standards that are in play. Sometimes, of course, it might be a good idea to invest in raising the standards above what's legally required, and for some projects, what you would ordinarily do within your company. That might be a very well thought through, reasoned argument for doing that. Stability, of course. How do the laws and these institutions change over time, and how do laws and regulations change over time? And then one thing I did want to mention, which is very current and very important in many parts of the world, is this idea of local content, which I know many of you have run into before. But the idea that a chunk of the project is carried out locally. And of course, the national oil company is often involved in these initiatives. So what requirements does your company have under the contract that you have, or under law, to use local suppliers, for example, or local equipment or local labor? Okay, so we're now into the why of the project. So we're moving into the why. Why are we investing in this particular project or taking this particular initiative? And the first place to start is the strategic fit. And we're talking here about the opportunity that is presented to you, and how does it fit with your company's strategy? What competitive advantages does your company get through this project, or what competitive advantages do you have that make you very well qualified to do this project? And what impact on your company portfolio will doing this project have? How does this project or opportunity impact the risk reward profile of your portfolio? And this is naturally split into a number of sort of high level groupings, and we look first at the technology aspect. So is there a particular aspect to the technology that's deployed on this project that your company is very well situated to carry out? When I say technology, this is a broad concept, so I take it to include any processes that you have within your company, any work processes, or people. For another example, people and skills and expertise that you might have within your company that makes this particular project a good fit for you. Then, of course, there may be aspects around the geology or the hydrocarbon type, or the stage of within the E&P life cycle that this particular project is well suited to your company. Another area of strategic fit might be the markets that you're serving, and any synergies that might be present with existing business that you have. So, for example, if you have existing production in a particular area and either access to or ownership of infrastructure, that might mean that this particular project that you're looking at is a good fit for you. There can be great synergies, and it's really important that your business case will show these. It's often found that synergies are not available to your competitors, so you really want to make sure that that shines through, because obviously that can then be a source of competitive advantage to your business. Another area where there might be good strategic fit is the country or the regional aspects, or the geopolitical aspects of where you're actually working. So it might be, for example, that you're working in an area where you have favorable relationships with service companies, or it might be you're intending to work in an area where you have very well developed and high performing partnerships with other oil companies. Those would be a couple of examples of regional aspects that might be relevant to your particular business case. Okay, so we mentioned briefly competition, and competition is almost always mentioned in a business case. It's that important. So let's dig into this in a bit more detail and explore what do we mean by competition in the context of writing a business case. And for me, it really means two things. Firstly, is the opportunity or the project that you're looking at a good fit with your company, a better fit for you than it is with your competitors, perhaps? And secondly, what do you have in your business that your competitors do not? What is it about you and your business? What competitive strengths do you have that your competitors do not have, that means that this particular project or opportunity is a natural home within your company? That's the real essence of competitive advantage. And so following on from that, we need to give some consideration to any competitive threat that might be present in the market in which you're working, and how your competitors are likely to respond to the project that you're doing. So as a very high level example, we work, of course, in a natural resource business. It tends to be that if you don't have the access to the resource, then your competitors probably do. So if you decide not to do this project, if you decide to give up this contract, if you decide to give up this license, then there's a chance that your competitors will get hold of it. So what does that mean for you going forward? I mentioned potential joint venture partners, and of course we see this a lot in oil and gas, is that folks that we're competing with might also potentially be our joint venture partners. So we can get into these interesting dynamics around you're actually partnering with a firm, but at the same time you're competing. And so if there's any particular nuances around that or particular angles that are important, you'll want to mention this in the business case. And I mentioned lastly, bidding strategy and premium as a particular example of how we see this idea of competitive strength play out, because it's through our competitive strength that we can bid higher than our competitors. So what is it about this particular project or opportunity that means we're uniquely positioned to own this asset that we're bidding on, and therefore allows us to bid more than our competitors? Okay, so that brings us on to economics. I'll hand over to you, Daniel.
Okay, the economics section of the business case is where you're going to demonstrate how your project will create material value for your company, which obviously is probably the thing that will attract the most attention from the readers of the business case. Absolute value will be important, but relative value may also be very important. You may be competing with other projects for available capital, so you'll have to show that the potential return justifies that you get the investment money. Or you might be deciding between a number of fields in a bid round, for example. So you would want to compare the potential returns from each field so you can decide which ones to go for. You'll do this with a financial model. And unless it's a very quick project where the time value of money isn't a factor, which is pretty rare in our business, you'll almost certainly create a discounted cash flow model to calculate the net present value of all the expected cash inflows and outflows. The model will also enable you to calculate another key metric, that's the internal rate of return of the project. This will be particularly important if your company works to a target hurdle rate, or if you're looking at more than one field and need to show which fields offer the best returns. There'll be a lot of uncertainties on both the income and expenditure sides, so your model is never going to be a precision exercise. In fact, budgeting to 10 decimal places is always dangerous. But you do need, more importantly, you need to make sure that all the significant CapEx and OpEx cost elements are included and nothing's been left out, or certainly nothing major has been left out. For example, you'll need to make sure you fully understand the tax and royalty regime and model all the tax outflows accordingly. You'll also need to understand your decommissioning obligations and build in the costs that arise from them. Leaving those out could leave you with a very nasty surprise at the end. Finally, on metrics, but by no means least, last but no means least, you'll need to decide on what discount rate you should use in your model. This will take into account your cost of capital and also the risk of the project. Neither of these is easy to decide on, and they'd merit a whole session to themselves. On sources of value, Angus has just spoken about the importance of competitive edge, but you'll want to demonstrate the additional value that your company can create compared with likely other bidders. This could be generated by superior technology or by tighter control of costs. And you may want to do what I understand from Angus BP does quite often in business cases, is maybe to show two models, one with and without that extra value that you bring. So to put some kind of value on your competitive edge. Decision quality is not something you always see in a business case, but this is about identifying how robust the key inputs to the model are. This will help decision makers to assess how much they can rely on the model outputs, so the NPV and the IRR, when making their decision. Clearly, if some of the inputs are a bit flaky, then they may take some of what the outputs with a pinch of salt and be a little bit more conservative in their assessment of them. On risks and uncertainties, the risks will obviously vary depending on the nature of your project. Is it pure exploration, or the other extreme, is it field redevelopment, or is it something in between? But there will still inevitably be a lot of uncertainty, particularly around how much a field might be able to produce, what the oil price is going to be in the future, what the hydrocarbon price is going to be in the future, and even more so if the available data you have is old and of poor quality. So you'll almost certainly want to supplement a base case model with upside and downside cases. I used to work many years ago now for a London listed independent called Paladin Resources, and the valuation methodology that the chief executive there used was quite simple. He did a base case with a discount rate of one level, I think 10%, and then he would always do his upside cases, which would have much larger assumptions on revenues, for example, but he would do that with a, say, 14 or 15% discount rate, and then look at the two together. But valuation is not an exact science. There are many different ways of doing it. Okay, back to you, Angus.
Okay, thank you. So the next section we have is on downstream opportunities. And in the first instance here, we're thinking of what processing might be required for the hydrocarbons in the field or close to the field. So for example, there may be impurities or contaminants that need to be removed. So in the case of oil, there might be water or sand or gas present. In the case of gas, there might be heavier hydrocarbons that need to be removed. Getting the hydrocarbons ready for transportation to the marketplace. So this often generates some trade-offs. So where does this further processing happen? Should it all happen at the field, or should there be limited processing at the field and further processing at a terminal, for example, or at the refinery? Where should the processing take place? And there'll be some trade-offs here that you might need to discuss in your business case. But we can take this a step further, actually, because there might be some really good operational and commercial synergies through the value chain. And back in the day, ExxonMobil was the exemplar for this, where you'd have a field producing oil, let's say, a pipeline to a terminal, to a refinery that was owned by one company. And this can allow you to generate some really good synergies across the value chain, whether they're operational or commercial or tax or maintenance or whatever they may be. Another aspect is control of infrastructure, which we'll look at with Daniel very shortly. So is there any competitive advantage that you can get through ownership or control of infrastructure? And beyond that, any product trading synergies that you might be able to leverage for this particular project? Okay, so that is the why of the project. We've covered the why of the project. We're now going to go through some sections on the how and the when of the project. And the first one we have is the granting instrument. So of course, we'll need to know about the petroleum regime that we're working in, the country's, which starts of course with the country's constitution. There will then under that be a petroleum law of some sort. There will be regulations, and within that there will be granting instruments such as licenses or contracts. So a key part of our business case will be the granting instrument and the fiscal terms contained within it. And it's also important to consider not just what the granting instrument says today, but what the situation might be in the future. For example, as governments change, as policies change, how might the interpretation of the various, the regime and the specific contracts that you're working with, how might that change? And so we bring into this, into the equation, the stability of the terms and any investor protection that you have, particularly in PSCs where you may have stability clauses, for example, that offer you some protection. Of course, a really important clause within the within your contract will be, or on your license, will be the minimum work required. So, for example, if you're at the exploration stage, what minimum work will you be required, the number of wells to be drilled or the amount of seismic to be shot? Or if you're at a field regeneration opportunity where you're looking to redevelop the field, what minimum obligations do you have, for example, to carry out well workovers? And a very important part of the business, because and the opportunity of the project that you want to do, because this will determine your absolute minimum expenditures and draw on resources as you carry out the project. Of course, there may be important aspects of the duration of the granting instrument that you want to call out in the business case. So, for example, what exploration periods are there? What targets have you been set in increasing production in an old oil field? There may be certain aspects around duration and major milestones that you want to pull out and highlight in your business case. Okay, now there are lots of different business cases in our industry, of course, and there are many different types of opportunities and projects that we carry out. And as an example, I wanted to just dwell for a moment or two on the development and production aspects that and concepts that you would expect to see in a business case. I do that for a couple of reasons. One is development is often the biggest investment, so it's important to many people in the industry to get this right, but also because it's important when we're generating business cases in other areas. So, for example, if you're developing a business case for exploration, let's say, or for appraisal work, you'll certainly need to consider that how you're going to develop the field in the success case and carry out an estimation of the full life cycle costs and economics. So for that reason, not everyone's going to be developing a business case for development. I know that, but because it's so important, we thought we'd give this run through this as an example. You will have your own opportunity situation that you need to demonstrate and present in your business case. So I appreciate that not everyone will be working on developments. If you are, there are essentially three parts to the development process: the concept selection, where you look at lots of different options; the field development plan, where you work up one particular option; and then thirdly and lastly, the implementation of the project. So in the case of the development, you may want to mention in your business case the recovery scheme that you plan, the number of wells, what facilities are going to be built, and what offtake arrangements have been put in place to get the hydrocarbons to the marketplace. And then you will build up a full life cycle cost estimate along with an estimate of production rate and recovery rate and reserves that will allow you to do the economics for the whole project. And again, I emphasize that this is still relevant in other projects and other business cases, because the example I gave was exploration, where you're certainly, before you start exploring, you'll certainly need to have an estimate of the life cycle economics. Oftentimes at the development stage, you will have to make trade-offs. And indeed, for the bigger projects, this is where oil and gas investors, oil and gas companies spend an awful lot of time and effort and man hours trying to optimize. As an example of a trade-off, there may be a trade-off between the reserves or the recovery of the hydrocarbon versus how quickly you produce it. So any major trade-offs may need to be discussed. You'll have to detail the schedule, major milestones, and importantly, resource availability. And when I say resource here, I'm not talking particularly about the hydrocarbon resource in the rocks. I'm talking about other resources such as people, equipment, available service companies. Are they readily available? Are there any issues that you might run into or any risks that you need to highlight to your decision maker? Talking of risks, of course, at the development stage, the three big risks are cost overruns, schedule overruns, and performance once the plant or once the project is commissioned. And there may be aspects of these that you need to highlight in your business case. Okay, that takes us on to finance. Back to you, Daniel.
Okay, successfully unmuted myself. The cash inflows and outflows that you calculated from your financial model that I spoke about before will enable you to calculate how much capital you're going to need for the project. You're obviously going to want to keep this to a minimum, but you do need to be realistic. If your funding capacity for the project is too small and can't cope with the impact of the almost inevitable cost overruns or delay in getting to production, you could end up being unable to complete the project or to meet your commitments under a license, for example, which obviously would be a big problem. In terms of phasing, the financial model will also obviously provide you with the data you need to decide when the funding will be needed. You'll want a clear understanding of the interaction of early revenues and later CapEx spend, because it may be that work can be phased so part of the CapEx is funded from revenues. That will obviously reduce the amount of capital you have to raise. It may also be possible to reduce capital required in other ways, for example, by starting with cheaper temporary facilities and only installing permanent facilities once production revenues are being generated that can pay for them. So there are various different elements like that that can help you to tweak how much capital you need in total. On use of funds, the business case should set out clearly how the funds are going to be used. It's fairly simple. And on source and cost of funds, how a project is funded is very much dependent on the circumstances of the bidder and any partner they team up with. Funding could be from existing resources, but that's obviously the easiest if you have enough capital available. It could be from new equity, or it could be debt. It will also depend on where in the the feasibility of that is dependent on where in the E&P life cycle the project fits. So if we're looking at development projects rather than exploration projects, there may be potential for debt financing, possibly even secured on future production. And finally, if you're planning to team up with a partner with existing capital to invest or with better access to new capital, this will obviously determine how much capital your company needs to invest and how much the total capital cost of capital will be. Back to you, Angus.
Okay. Let's get me on to the next slide. Infrastructure, are you doing that one, Daniel?
Yep, sorry, back to me again. A little bit about infrastructure and export systems. How you'll manage the offtake of the oil and gas produced will be a critical aspect of project viability from both an operational and a financial perspective. Whether the project is within reach of existing pipeline infrastructure, and if so, how far it is, will make a big difference. If it is within reach, you'll need to determine whether there is spare capacity, and if so, what tariff the pipeline owner is likely to require. And the supply and demand dynamic will determine whether you'll be able to negotiate a good tariff rate. With perhaps another little example from my time at Paladin Resources, and perhaps one of the key things that made our chief executive very successful was we did a lot of projects in the North Sea, and he particularly focused on projects where there was more than one set of infrastructure near the project, which meant that he was able to to trade off between the two infrastructure owners to get a decent deal. If there's only one set of infrastructure out there, then the chances of getting a deal that favours you is much more difficult. So if there is no existing infrastructure close by, you'll need to assess the feasibility, both the technical feasibility and the financial feasibility of building it yourselves. You'll need to bear in mind that you may have to truck production initially before pipeline infrastructure can be built or indeed afforded. That will obviously be costly and may bring operational and HSE issues with it. For example, is the route safe? Can the road and bridges along the route cope with the additional traffic? In terms of existing versus new, both the next 2 points lead on from this, particularly if the project is relatively modest in size. Using existing infrastructure is likely to be more economic and will reduce the project's capex and therefore its funding requirements. On the other hand, if there's no existing or available or affordable infrastructure nearby, you won't have any choice but to build your own, and we'll have to factor in the costs accordingly. And the point on other infrastructure and like roads and bridges is quite a simple one. Basically, just don't forget them. If the project will require new roads or bridges, the cost could be considerable. So if cost isn't factored into your modelling, your project valuation will be overstated. Now I think it is genuinely back to you, Angus.
Okay, thank you. Let's see if I can move it on to the next slide. There we are. So next section, we're still in the how and the when is around HSSE, health, safety, security and environment. And your business case will need to demonstrate that you've considered the major hazards that might be present and the major environmentally sensitive issues and how these are going to be dealt with. So demonstrating that you have a rigorous HSSE management system in place that's adequately resourced and costed for the particular opportunity that you're presenting. Along with, of course, risk mitigations that might be required, and any CSR aspects that may be relevant to your particular project. And when I say CSR, we're talking here about corporate social responsibility. So that means any aspects of working with the local community that are important for your business case, or any risks that are present that may be necessary to highlight to your decision makers. Okay, and the last section we have is around supply chain and logistics. I have to say I've been involved in quite a number of business cases over the years. And I think it's true to say that the majority do not pay much attention to supply chain, the ones that I've seen anyway. But it's obviously an important part of our projects and our investments. And sometimes it's really important that we highlight issues around supply chain in the business case, because supply chain is all about getting the right equipment in the right place at the right time at the planned cost. And if there's any risk or opportunity around that, then we should certainly detail it in the business case. So how is the supply chain going to be managed in a sustainable way? How are we going to optimize specifications? For example, will we over-specify in certain areas for equipment? What's the total cost of the supply chain? We're not only going to procure the equipment and supplies, but we'll also need to transport and store them at site. How do we intend to manage our suppliers in regards to performance management and innovation? And for some of the really big projects, not every investment that you run into, but for some of the bigger ones, we might decide to take a more strategic view and category manage various items within the project. So, for example, if we find that we're spending a lot of money on various aspects of IT, it might be better to treat that as a separate category and take a strategic approach to the IT spend, and perhaps rationalize the number of suppliers, or maybe give it all over to a one-stop shop organization. But in any event, whatever you decide to do, take a more strategic view for some of the bigger and more complex projects where category management is important. Okay, and I just looking at the clock here, it's coming up to 10 to 2, so we've overrun just a tad, but we still have plenty of time for Q&A, and we'd love to hear your thoughts on business cases or any questions that you might have. So if you do have a question, could I suggest that you go over to the chat box, and if it's not in the toolbar on Zoom in front of you, then go along to the more on the right hand side. It's three dots with the letter more, the word more underneath, and you'll see that you can open up a chat box. So I'm going to head over there right now and see if we have any questions. This one in from Tim, a question. I've come across other financial and non-financial considerations in business cases. Costs of carbon, sustainability, social impact. Some of these can be included in the economic analysis, e.g. the cost of CO2. What have you seen in recent times with the pressures on the industry to contribute to net zero carbon? Gosh, that's a great question. A very high level, big question. Any thoughts on that, Daniel, come to mind?
Well, it's possibly not really answering the question, but I think the one comment I'd make is, particularly as projects tend to be quite long, and this is an area that's very much in a state of flux. So when deciding whether or not there is going to be a financial or non-financial aspect due to government intervention, for example, in the area that we're investing, you can't just think about the current state. You need to think about how it's going to be through the life of the project. So because it may very well change, because clearly things, as you suggest in your question, are moving in that kind of direction. But I don't have any specific knowledge of exactly what's going on in absolute terms. It's more just highlighting that trend in a particular direction.
Yeah, where I've seen it play out more, and interestingly, a very similar question to this came up in a session on ESG that we ran last year, and we're going to repeat this year, environment, social, governance, ESG. And that came at the problem of emissions from a different angle, and that was around measuring impact and mitigation. So what I've seen folks doing in the area of emissions is, and it might not necessarily be laid out in the business case, but someone somewhere will be laying out what will be the impact of the project on emissions, what alternatives have you looked at for the project, and what impact do those alternatives have on emissions, how are you measuring the emissions, and what mitigations for your chosen project have you put in place to try and manage the emissions. Now, for bigger companies, these can play out across the portfolio, so you can offset one area of activity with another activity, so it gets quite complex. But for smaller projects and the ones that I've seen, that's the way that it's been laid out. Okay, another question. This one came in from David. example would be BP with a target carbon neutrality by 2030. So a business case there would have a carbon account which would be taken into the center for accounting. Yes. In much the same way that we already do hydrocarbon accounting, I would imagine. Much the same process. Okay, any other questions or follow-on thoughts? Okay, another question, Tim. Thank you for this. What advice would you give regarding the business case and its evolution as part of project development and the key decision points such as project initiation, project selection, final investment case? Any thoughts on that, Daniel? What advice would you give regarding the business case and its evolution as part of the project development and the key decision points such as project initiation, project sanction, final investment case?
I don't think I have anything meaningful to add, except really to underline what your point is quite rightly saying, which is that a business case is not just a point in time. It's very much it should be a living document, and that serves different purposes at different times.
I mean, this is speaking to the project governance system that you have, and in some project governance in some companies known as the stage gate system, which is quite well developed in the larger companies, but not ubiquitous, and certainly not well developed across the whole of the industry. And in fact, when we look at project performance across the industry and areas for improvement, project governance is one of the areas that comes up a lot. And there's a strong, I don't see much of what you're hinting at in your question. Historically and culturally, and the way we've always done things is very linear, and quite unresponsive in many ways to changing dynamics, to the changing environment. And I mean, it's really interesting to see this play out in the area of digital investments and digital projects, because as many of you may know, the digital projects are run in a very different way, and you may have heard of the term agile. And there's some concepts from that particular world which do not lend themselves or are not easily taken up, let's put it that way, in the engineering world. So the idea of failure and failing quickly, trying things out and failing when you have to and quickly. The idea of being able to rapidly move on to other opportunities as the situation develops. So I think we've got an awful lot to learn from the digital area that we might deploy in some of our engineering projects. I think the other thing to mention is flexibility. And we do see this in business cases from time to time, but we still struggle a little bit with the idea of flexibility, or building in flexibility or optionality into our projects so that we can change direction quickly. So framing it in those terms might be a nice way of presenting it in your business cases. And we can't do this today, obviously, but there are many techniques and tools out there now that you can use to put a value on flexibility and and communicate that in a well thought through business case. Any other questions? No other questions, just having a look through. Doesn't look like it. Okay, I think then in that case, we are done. It's coming up to the top of the hour, so we're pretty much bang on time. I'd like to just finish off. If there are no further questions, I'm having a look over there, and I don't think there are. No. Let's just finish off with a quick look at what we've got coming up at WBC. We've got a number of online courses coming up, and these are typically over 5 days in 2 2-hour sessions per day. So we've got one on contracts and negotiations in oil and gas in February. We've got Fast Track to Leadership in March, which is for folks with 0 to 5 years management experience typically. We have High Performance Leadership also in March. That's really for folks with 5 to 15 years management experience. And then we have the 3-day MBA in oil and gas in April. We've also brought in a number of online workshops. These are typically 1.5 to 2 hour sessions, so bite-sized chunks, short, don't have to spend too much time out of the office or away from your desk, interventions that can still have a big impact in various aspects of our business. So I mentioned a few there. We've got many of these: procurement and supply management, leadership development, the clean hydrogen opportunity. I think we've got over 20 now, so there's a whole bunch there to choose from. Our next webinar will be in February. It's on crisis management. That will be on the 16th of February at 1 p.m. Okay, I think that's it for now. I'd just like to thank you for your attendance. I appreciate having you on the call today. I hope it's been useful for you. And we very much look forward to seeing you at a future webinar. Thank you and goodbye.